Welcome to the Mentis podcast. Today we have Adam Sharif with NxtCRE. Adam, I appreciate you coming on.
Thank you for having me, Nick.
You have a very interesting company. You've had a long experience in the commercial real estate space, and now you're bringing tech into the real estate sector. So tell us a little bit about it and kind of where you got the idea.
All right. So what NxtCRE, what we do is we help commercial real estate lenders, who are partnering with us gain line of sight into their own customers' equity reinvestment and debt funding needs. About 20% of a lender's portfolio, generally speaking, right? About 20% of a lender's portfolio will run off every year. They'll be paid off due to either sale or refi. Of the 20%, only 25% are refinanced, but 75% are paid off due to a sale. Lenders do a really good job of identifying those who are going to refinance. In fact, they're looking at the maturity dates on loans, and 2 years ahead of the maturity, they'll contact the borrower whose loan's coming due and trying to get them to refinance. But 75% of those who are paying up their loan are doing it due to a sale. And once that happens, the lender no longer has a line of sight as to what they're going to be doing next, right? Because the loan's paid off, they're no longer a customer. They might have another loan with them, but as far as that partnership is concerned, as far as that LLC or that ownership structures, that's an exiting customer for the lender. And so we've came up with a concept that will allow lenders to know not only what they're going to be doing, those borrowers, what they're going to be doing once they pay off their loan, but also to help those borrowers identify their next reinvestment. Because of the 75%, about 2/3 of those people who are selling their properties will be reinvesting the cash from the sale to buy another property. It's a giant market. It's about 70,000 transactions a year. They buy about $400 billion worth of investment properties and invest $150 billion in equities, $250 billion in debt. That's a giant market. And giving lenders a better sight or a clear line of sight to those borrowers' next move is a very valuable proposition for the commercial real estate lenders. Commercial real estate lenders who are partnering with us get a dashboard, and they get to see those activities and jump in at any time and provide the acquisition funding for that next for the reinvestment of cash by these borrowers or ex-borrowers.
So let's take that a little bit step by step here. So we're selling a property. We have a bank, and the bank will either, typically, like you were saying, in a refinance, will know, okay, hey, this is going to stay on the books for a while longer. It's going to be a profitable loan. They can count on it in their pipeline. But if you're selling, that relationship ends, and then I go on and I find a new property and likely a new lender, or at least I start shopping it out to other lenders. What makes the buyer or the person who's selling the property, I guess, what makes the operator put information on your platform because obviously the lender, this is valuable to the lender, but what makes it valuable to the operator?
Great question. So one thing we know about people, investors who want to invest money, they want to see every opportunity in the marketplace, and especially true for those who must reinvest. We call them must-buy investors. Those are folks that are using 1031 exchange rules or a tax code to defer taxes on those gains. So when they get a notice from their lender that they want to help them identify their next property, there's an assumption, a correct assumption on part of the borrower that lender has other borrowers that may have properties that they want to sell off market or otherwise, or maybe there's a distressed opportunities the lender's dealing with one of their borrowers, and maybe that's an opportunity they can look at. So, and they wouldn't be able to do that until unless they told the lender exactly what they wanted to buy. Let let me step back a little bit, even further back, and tell you how we get to even know this is going on. We use what we call an early warning signal, which is a fancy term for saying a request for a loan payoff. When a borrower has a property and they're going to pay off their loan due to a sale, the loan docs will say, yeah, you got to let me know. The lender's loan docs will tell the borrower that you got to let the lender know 30 to 45 days ahead of when you're paying off the loan that you'll be paying off the loan. The lender needs that time for a variety of reasons. And as soon as the lender receives that notice from the borrower, we call it early warning signal, immediately our platform, because we use an API with our lending partners, will send to that borrower an email with a link to a questionnaire that's branded with a lender's logo. So as far as the borrower is concerned, he's getting the message from the lender, not from NxtCRE. And the message from the lender is, tell us why you're paying off your loan. Well, there are only two choices, either refinancing or selling. And if you're selling, the lender will ask, well, are you planning on reinvesting the proceeds? And if the answer is yes, the questionnaire continues and asks, well, what do you want to buy? Where do you want to buy it? How much equity you're going to have, and what's your price range? And so once the borrower receives that, completes the questionnaire, it shouldn't take the borrower more than minute and a half the most to complete the questionnaire and submit it. That information gets onto our platform, and we're not a listing site, so you don't get on our platform and see a list of must-buy investors. But if you're a property seller, you upload your property information. Again, we're not a listing site. You don't get to, you can upload your property information anonymously. No one will know it's on our platform other than the MBIs that you matched with. So like a dating site, you upload your property information, we'll match you with multiple must-buy investors, and you pick and choose which ones you want to send the property to based on amount of equity they have and number of days until the selection deadline. So you asked me how I came up with this concept. This is an old concept that I created when I was at GMAC. When I was at GMAC, I ran the equities transaction group. I was a member of the senior management committee at GMAC. And we had a servicing portfolio at that time about $300 billion. Today, that would be a gigantic amount. We were by far the largest player in the marketplace. We were the 800-pound gorilla, and we would look at, and I would get access to all kinds of data as to what was going on in the marketplace. And I noticed that most of the loans that were being paid off through the sale. So I asked, well, what's going on here? There's a capital event. How can we take advantage of it? The answer is, well, they're not refinancing. We don't care. And I'm like, wait, I run the equities transaction group. There is a capital event involving tons of equity. I most certainly care to learn more. And I was given free rein to go research it as much as I wanted. So we contacted those borrowers and asked them, what they were going to do once they paid off their loan. 2/3 of them said, hey, we're going to reinvest it. And we asked them if they'd be interested in seeing opportunities from us. And of course, as I mentioned before, they assumed correctly that we had all these other borrowers, thousands of other borrowers, tens of thousands of other borrowers at that time. And some of them could be in trouble. Maybe it's a defaulted opportunity, or maybe or distressed opportunity, or maybe it's a property seller that doesn't want to list their property but would sell it to, if they had the right buyer and place. And so they were very excited to tell us exactly what we needed from them in terms of what they were going to buy and everything else. And then we went and contacted our other borrowers who were actually thinking about selling their property, asked them if they'd be interested in selling their properties to these 1031 exchange buyers, who we now call must-buy investors. The response was universal, right? Oh, these people have their cash on hand. They have a very short time to make a decision. So as a property seller, I know I'm not going to get strung along, right? I got a real high probability buyer here. And because they were investing cash that otherwise would go to be paying taxes, I know as a property seller, they care more about deliverability than they care about making the deal of the century. So they were very excited to say, yeah, we'd love to sell our property to your must-buy investors. It worked too well. It got to the point where we couldn't, it was like shooting fish in a barrel, except it got to the point that we could not service all the customers, all the business that we had. Back then we had phone, fax, and FedEx as most often used source of communication, and that just wasn't enough. Even when we were identifying the needs of our investors 90 days ahead of the selection deadline, by the time you collected information from one side and collected information from the other side and started communicating it back and forth, we didn't have emails or attachments and Adobe, we didn't have any of that stuff back then. It got to a point where it just got, we started embarrassing ourselves because we couldn't handle the volume. When one of my team members would see an opportunity, they would shepherd to closing as opposed to working on new deals coming in all the time. And so I would have had to hire another 80, 90 people to take advantage of the opportunity, which I didn't have been doing. So I left to become a developer. I developed in 3 different states: Illinois, Texas, Florida. Florida is where most of our deals were. And in fact, in Florida, the first deal we did here was an acquisition of a George Soros REIT that included a 517-unit waterfront property, waterfront apartment complex. And it was a fantastic opportunity. We went on to develop 1,000-unit townhouse developments and a bunch of other stuff. And about 3 years ago, seeing what technology was doing to various different industries, I started thinking about what technology could do with the concept we had back at GMAC. The problem we had back then was we couldn't handle the volume because we didn't have a fast enough way to communicate the information. Well, with technology being what it is today, that problem went away. And so, of course, I no longer work for GMAC, so then I had to go find lenders that wanted to partner with us. And it took us about 2.5 years to build the platform, find lenders to partner with us. And today we have lenders that partner with us across the nation, from LA to Miami, Chicago, Detroit, Texas, New York, and a bunch of other places in between. And so it took time to build that, and starting this year, we started allowing our lending partners start using our platform, and right now we're having really good success.
Well, thank you for the background there. I mean, that's a really fascinating story, and it makes a lot of sense. I see, at least from kind of what I'm hearing, it sounds like there's really 2 value propositions here. One is to the lender, who can at least be notified, hey, that loan is being paid off, and okay, I'm going to send out the survey. This person is going to be reinvesting. Let me get the commercial loan officer on the phone with the customer and call them and say, hey, we're here. We would love to work with you again, or potentially that's one option. Yeah.
If I may, just a little. They don't even have to make a phone call. The lender gets a dashboard where they can see the activities. They can see what properties the must-buy investor is reviewing. They can see the kind of information they're receiving on that property from the seller, rent roll, operating information, all that sort of stuff. They can see if the must-buy investor would be submitting an offer. So they have all this data right there on their dashboard, and they can come in and be a little bit more proactive and give them a specific quote. I see you're looking at this property. Here's how we see it. We have all the information to underwrite it, and based on that information, here's a quote. And by the way, since this is a direct quote to you, meaning there aren't any outside brokers piling on fees, your cost to do this deal, take our loan, is lower than it would be if a broker was coming in and bringing you that deal.
Right. So, I nothing against brokers, but the direct shot at that industry is, frankly, I think needed. A lot of times there's brokers who don't provide a lot of value and they just want a large fee. Other times they more than deliver it, and that's when you're happy to pay them. But in this particular instance, it really sounds like you're kind of just playing matchmaker with lender and borrower who previously already had a loan with them, and kind of just making it a little bit easier for them to stay in touch. And
I would say it a little differently. What we do is we connect the must-buy investor with property sellers.
Okay.
The connection exists between the lender and the exiting borrower, right? Whether it's the connection being broken or not, there was a connection there. We're trying to maintain that connection. We're trying to make sure that the lender does not lose that connection that they already have. So that's what we do for the lender. Must-buy investors, now they can now the value to them is now they have greater number of opportunities to look at in terms of acquisition.
Well, okay, so that's the second value proposition that I was seeing. And so on the lender side, are you providing all of that for free to the lender?
Yes.
I figured as much. So you just go there, you partner. Here's the dashboard, just incorporate it, easy, right?
Right.
And you're not getting anything even if they close on that loan.
Exactly.
You're charging the 1031 guy, excuse me, probably the buyer, or the seller. I'm not sure where are you getting your money on the.
I was going to let you go with that till I was going to tell, and then no, we don't charge anything to the borrower either, the must-buy investor. We don't charge them anything. It's all free to them. The only people that pay anything are the commercial real estate sellers or brokers who list those properties. By the way, we are very, very broker friendly. We are, in fact, if you go on our site, play on how it works, we encourage property sellers who aren't coming to our site with a broker to use a broker. We don't demand it, but we do encourage sellers to use brokers because we think brokers add real value. Maybe they're not the value, maybe they're not creating the value of being a procuring cause, but property sellers need brokers a lot more than just being the procuring cause. What they need is representation. They need someone to help them basically be the shock absorber between the two parties, because sometimes you get personalities get in the way and styles and they don't always match very well, and that's job of a broker to make sure that doesn't get in the way.
That's the listing broker, but you also have like loan brokers.
Loan brokers, right?
Yeah, and that's you're trying to get that out of the deal.
Yeah,
and broker stays.
Yeah, I will tell you, within even the mortgage banking business, loan brokers are not viewed as the same level. We're better off without having mortgage bankers are different. Mortgage bankers, they have their own loan, their own stuff. That's different. But mortgage brokers are in commercial real estate can sometimes add. And they create value too, don't get me wrong, but they can also sometimes increase borrowers' borrowing costs as well.
It also attracts sometimes at the lower level, it attracts kind of an unsuccessful salesman, if you will, and they can go sell the world to the person who is looking for a loan, but they can't deliver on the other side, and then it can slow the transactions down, or they just really, in a way, causing pain or kind of slow down to the deal. But not to go off on that tangent, but the listing property, so like we're selling a property, we list it on your site with or without a broker. The only people seeing these are people who are must-buy investors
that are matched with you. So we don't. So if a must-buy investor wanting to buy a property in New York City isn't going to be matched with a property seller selling a property in LA. But first of all, it's only must-buy investors. Second, only the ones that are matched, that have a matched need to your selling side. So if there's an MBI in Miami and there's a property seller in Miami, or someone wanting to sell a property they have in Miami, then those two will be matched.
So I sell the property on your site. I'm now instantly considered a must-buy investor if I'm doing a 1031, and then now I'm being shown properties.
So let's say you send your notice to your borrower that you're paying off your loan. Right there, we're going to determine whether you're going to be reinvesting or not. If not, if you are, then you are a must-buy investor. And those who are selling your property will also will get matched with you based on what you're looking for. And then if that property seller then wants to reinvest themselves, because 2/3 of the time they do, then we will try to talk to their lender, try to partner. If we're not a partner of their lenders, we'll reach out to their lender, trying to make them a partner of ours, so they too can have the benefits of our other lending partners will have. But that's basically how it's not difficult. It's simple. We see the cycle. We see the business as cyclical as opposed to a straight line, right? Transaction starts, transaction finishes. That's how most people look at it. We don't look at it that way. We see this as a circular world where today's buyers are tomorrow's sellers is day after tomorrow's buyers, and that sort of stuff. So that's how we look at it. So we have value proposition for the must-buy investor. They get to see more opportunities than otherwise would. they have a better chance of getting a loan from their lender that has a lower cost to it. To the property seller, they get to sell their properties to the most desirable investors in the marketplace, increase their probability of closing, reduce their marketing time and cost. So that's for the property sellers. And for the lender,
now, the property sellers have to notify that they're going to be paying off their loan to be listed, to then get access to the buyer side. So like like a general buyer, let's say like a third party just has equity from running their other company or whatever, wants to come in and buy one of these sites. That's not who you're targeting right now.
you're not,
Okay.
no,
That's for other, that's for other sites.
right.
You're targeting kind of the investor who's already in, sells their property, is going to be, I see it's a little different. I mean, that's definitely a different approach here. How many people do you have on the platform?
What do you mean, number of people? You mean
so
number
how many
of
people
properties?
how many people are using?
Oh, we have hundreds of thousands of property sellers uploading their property information. We are on a daily basis, we're getting new MBIs on our platform. Yes, just yesterday, we got an MBI from one of our lenders. True story. The MBI has got over $100 million in equity and is looking to acquire apartment buildings valued between 150 225. Sweet spot's going to be around 175 million. Low leverage, perfect type of lending opportunity for the lender, because low leverage loans are the most desirable kind in this market, right? You don't know, there's a lot of uncertainty. You don't know where interest rates are going to be. You don't know if there's a recession or not. We don't know how inflation is going to play out. So much uncertainty, but you still want to do business as a lender. You still want to put money out. So you have an opportunity to put out such a large amount of money on an acquisition at 40% LTV. Well, that's exactly what you want. You get a higher interest rate, you got lower leverage, it's a safe loan, you got an opportunity to put out a lot of money in one. So this is a great opportunity for the lender as well as. But here's one other value proposition we haven't discussed. The seller pays 3/4 of a point on a successful transaction.
Yeah, I was going to ask.
Successful.
That's actually a great. It's a great amount. That's extremely low.
Yeah, and we give 2/3 of that to the lender. So the lender gets 50 basis points as well as opportunity to originate a new loan. So those are
so now you're really incentivizing the lender to call.
They're a partner. They're a true partner. Without them, we wouldn't have a product. Our product is providing access to must-buy investors.
So how many sellers know that the lender's getting an extra 50 bips at the sale, because they might start beating up these lenders on their origination fees if they knew?
The sellers and the lender they don't meet at all. The seller is selling his property, paying the fee, but they're not engaged with it.
I'm sorry. The new buyers are coming in. They're getting approached by the loan officer.
Well, not only will the new loan that they'll be getting not have a brokerage fee on it, right? But they don't pay anything. It doesn't cost them anything at all. And so, so this is a partnership that those fees from the selling side is going to get paid anyway. The buyer knows that, and the fact that some of that money will go to a lender is irrelevant, because that borrower is no longer a customer of that lender anyway, right? He sold his property. He might be a future borrower, but that's okay too. So I haven't heard any borrower say, hey, you're making money here, you're making money there. So
no, it doesn't seem like it matters. I mean, it came out of the seller's pocket. So yeah,
exactly. Yeah.
So you guys walk away with 25 bips a transaction.
Mm-hmm.
It sounds like you need high volume, or you must have an extremely tight skeleton crew trying to survive on those fees.
The answer is yes to both. Again, remember, this is a $400 billion a year market. All right. So if we just did 25% of that, that would be $100 billion a year, right? 25 basis points on 100 million is, I think, 250 million a year. So yes, our goal is to have volume, and more volume.
Is there a deal size that's too small?
That's the that's the thing. I just gave you an extreme example, right? Which is very unique because the average must-buy investor deal is around 7 million, but they range from anywhere from 6 figures to 9 figures.
Of course. Yeah.
I think our system would start flagging things that are less than, $250,000 or something like that. We start saying, wait a minute, this are you sure you got this? Are you sure you got this thing right? But so yeah, so they, although it's 7, average is 7, it can go from $250,000 to, I just give you an example of someone looking to buy something in $175 million sweet spot.
Yeah, you guys are really running the gamut of size there. I mean, that's some of the larger deals in the country, and
it's like I said, we just did a case study. It's like whatever the lender's borrowers are paying off, right? How much cash are they going to have? It's all up to that. Lumen, who's our most recent partner, Lumen is Oryx company. Oryx has $85 billion in asset under management, and Lumen has $50 billion in loans with 7,000 borrowers. And Lumen and we just got an MBI from them on someone looking to invest $4 million, right? I mean, no, buy a property at $4 million. So it's really all over the place, So we've got this 100, someone has over $100 million they want to reinvest, and then we've got those folks that have $1 million they want to reinvest. So it's a wide range.
So if I'm sitting there as a new commercial loan officer, it sounds like I would do anything to get my hands on your information, especially if I was seeing other lenders, customers getting like access to other lenders that are going to have their customers leaving them. Wouldn't you just be picking up the phone and calling and just saying, "Hey, I see what you're going to be selling, or you're going to be"? Isn't that kind of like it's a huge value to the lender, or is that really not the target? It's just kind of going to be something that happens.
We want to have partnership with every commercial real estate lender in the nation, but when you're presenting a brand new concept, something that's never been done, something that almost sounds too good to be true, you start thinking, okay, there are strings attached here. I don't know where they are. I don't know. I don't know where to even start looking. I'll let someone else go first, which is exactly what happened. And the first lender was the hardest lender we signed, and on. Took us the longest time to sign, but with each time we sign a new lender, the next one becomes a little easier. And so as we start showing other lenders actual proof of monies being put into lenders' pockets, lenders actually seeing their borrowers' borrowing costs get reduced, then there's less to worry about in terms of unforeseen dangers that might make this whole thing undesirable, because other lenders have had the same concern, and if they've gone through it, they've signed off on it, their compliance department has signed off on it, their legal has signed off on it, their marketing group has signed off on it, then maybe I should take a better look at this and see exactly how it works. That's our goal. We're looking to add to our lender liaison team. These are people whose responsibilities are to sign new commercial real estate lenders as partners.
It doesn't sound like there'd be much liability to them. I mean, if you keep your documents really straightforward, there'd be no liability to them.
And it can be canceled at any time for any reason or no reason at all. The only thing we do ask our lending partners is that they agree not to do the same thing with someone else for a period of 3 years, meaning that if someone else comes in, a Johnny-come-lately copycat wanting to do what we're doing, we're just asking the lender that just because they're going to give you an extra 5 basis points or something like that wouldn't be fair to us, wouldn't be fair to the investments we've made and the commitments we've made.
Sure.
So we ask you to wait for 3 years. It's the way we create our moat to keep these copycats from jumping in and doing what we're doing.
So, being from the real estate sector, 2 things come to mind. One, are you cash flow focused for your company as a tech startup, or are you kind of going the private equity route and grow it big and then sell it? And two, where did you get the programming knowledge? And have you always been into tech and you know, been able to kind of go across the sectors?
No. We that's part of building the company, the platform.
right.
When you're looking to build anything, you have to identify the components necessary. But if you're building something that's never been built before, that's not that easy to do. So it takes a while. You do have a good idea of a high level in terms of the components you need, but you need to have the team to sort of build the components first, and then put the components together and everything like that. So we did we had several people that on our tech side, not all of them worked out. Some of them just had gaps that just weren't good, but our current tech team is fantastic. I can't say anything we have is so original, and as far as tech, that it would be proprietary, like no one else has ever done it. The matchmaking part has been done, you know, on dating sites and things like that. The uploading property information is nothing new. Identifying, doing the Google map thing and making sure that you identify the markets where you want to be and all that sort of stuff. It takes time to create all that, but and it takes time to put together the architecture, but none of it is such that it's so brand new that if it didn't exist, we wouldn't be in business, sort of thing. It's just tech. We're tech enabled, not a tech company. That's the way I would describe what we are. But yeah, we have an amazingly talented team. Doing the tech, building the platform was probably what took the longest to do, because we were starting from scratch and we didn't have any architecture. We didn't have anything. You know, we started out with, our first, it was just so rudimentary, right? Just initially.
You got to start with the wireframing out, and when I click this is what's going to happen. But it takes a lot of time, and then kind of building that technical spec out. I totally understand what you guys went through, and I was just curious on that front. What about the cash flow side? Are you guys gonna?
We're all about generating cash flow,
okay.
And we're about both. Here, we are a private equity backed platform, but our private equity partners are really very adamant that we provide positive cash flow, and our partnership agreement, the terms of their investment is such that if we don't, we get penalized. So yeah, so we're very, very interested in being cash flow positive sooner rather than later. But at the same time, we're also trying to scale. We're trying to sign new lenders and everything else, getting them to start using our platform.
But there is something to be said about doing both at the same time. And I think the tech industry got drunk on cheap money, and they just grew and grew, and we have a burn rate of X amount a month, and it doesn't matter if we're not going to make money for the next 5 years, we'll just keep raising more and more and more. But times get tough, and then some of those companies go away, and I think that the appetite for that, it's still out there, I'm sure, but it's probably less attractive to investors who would like to see maybe just a little slower of a growth, but okay, they're actually maturing, they're growing their cash flow. Now we're not just growing top line, but we're also getting profitable, and we can actually see this scaling. And I think it's more desirable. But
of course, but everyone says, when they see a successful model, they want to copy it. So Facebook, right? Mark Zuckerberg says, I don't care about revenue. I don't care about revenue. I want users. I want users. I want users. And that, of course, turned out to be spectacularly successful. And, Twitter and on and on and on. They were like I shouldn't say countless, but there were so many of these tech companies that weren't making any money, but had, unicorn valuations. It was crazy. So you're a new VC, you're out there raising money. You want to model, your platform like all the rest, and they all start doing the exact same thing. And one of the things I've noticed in commercial real estate is those who have launched commercial real estate platforms have all been successful in B2C marketplaces
Yep.
and in residential marketplaces, and thinking, well, they can just take that and bring it onto commercial real estate and they'll have the same level of success. To date, I don't know of one commercial real estate marketplace that's been successful or is successful. In fact, there was one recently, Lev, I don't know if you're familiar with them, but they raised $200 million and they just closed the entire, they were a debt platform. That's their whole job, was to provide, basically be a broker. And they just closed the entire loan origination platform, which is the whole business, which is the whole, now they're just going to start selling their software to lenders, doing whatever, I don't know.
Sure.
But it's very interesting that you don't see a whole lot of people in commercial real estate with background in commercial real estate launching commercial real estate tech platforms. It's very unique. The ones who are doing it have almost no experience in commercial real estate. And they're getting in, they're trying all kinds of stuff, but people that are in the business aren't doing anything. It just blows my mind. We have, as a team, 150 years of commercial real estate capital markets experience. So we know the business, and we're probably the only one out there that I am familiar with that level of experience, who've launched commercial real estate tech-enabled platform.
Sure. Well, I mean, your experience is going to pay dividends. I have no doubt on that front. What's the end goal here? Are you going to sell it to a big, large company right off into the sunset? Or are you going to run this thing till you're,
Well, it's a great question. I'm a better builder than I am an operator. I mean, I learned that in real estate. I mean, I'm much better at building. I'm much better at creating value than I am at sitting back and clipping coupons and that sort of stuff. So when it gets to the point where we're doing that, I'll be finding something else to do. But I don't think about selling or any of that sort of stuff. The company, someone else will make that decision down the line. But if we're successful as we think we are, if we generate the kind of cash we think we will be able to generate, and given that we're a very economically efficient platform, any option we want will be available to us.
You're absolutely right. And if you have cash flow and you're profitable and you're continuing to grow, and the tech's, I mean, that's really hitting the gold mine. So I wish you absolutely the best. I hope that you guys kill it with it. Before I let you go, quick current events. I think we hit peak interest rates this week, or last week rather. This recording's as of May 9th, 2023. So last week, Fed goes up another 25 basis points. I'm hoping that's the peak, but we obviously got to watch what's happening with inflation. What's your take on the market?
Well, the consensus is that they're done, right, with raising rates, and there's all kinds of uncertainties, and some people are spooked by, are worried about crisis, all kinds of different crises coming up from what I'm seeing as a mini bank crisis, if you will. Just it's not a big one. It's yes, every year banks fail, but usually not banks this size. Because of all of that uncertainty over the last 6 months, end of last year, beginning of this year, transaction volumes have slowed tremendously. As people get more comfortable, accustomed to the new normal, which is really the old normal, if you really think about it, where rates are today aren't that different than they were, maybe 10 years ago, 7 years ago, something like that. Yeah, we had to lower the Fed rate to deal with the pandemic and that sort of stuff. But people will get used to the new normal, and then they'll start accepting it. And once that happens, we think deal flow would come in. There's about $600 billion of commercial real estate loans that are coming due over the next 12 months. And some of those, and by the way, since most of those have been held for a long period of time, 7, 8, 9, 10 years, average hold is 7 years, let's say, there's been a tremendous amount of equity built into those properties from income increase and resulting in an appreciation of value. So those lenders aren't going to do anything. They might give you a couple of months of extension from the due date just so you can ride out the uncertainty. But when people get back to realizing that this is the new normal, I think we're going to get back to the way things used to be. Now, if you're a property seller and you have to, you're thinking, okay, I got to refinance and lock in my equity for another 7 to 10 years, or if I sell today, I have to sell a high cap rate than I would have a year ago. That's not attractive either, but those are my two options, right? So I'm going to go ahead and sell it because although I may not get the cap rate that I thought I was going to get a year ago, I can now reinvest my proceeds and buy at a higher cap rate than I otherwise would have bought over a year ago. So the downside of selling in a down market is the upside of buying in a down market. And we all know in commercial real estate, you make your money on the buy.
Well said. I could not agree with what you just said more. There's an opportunity cost to everything that we do, whether we stay in a refi or sell our properties. And I think that you are spot on. You're the first person I've actually heard say that the transaction volume probably will tick up just because sellers will say, you know what, all right, even if I just get my money back, I'll take it back. And let's just go try another one, because people are fee driven as well in the market, and they just need to do transactions. So if they can ink out a 10, 15, 20% return, I'm pretty sure most sellers are going to take that, put it on the market and walk, even though they could maybe hold on for another 3 or 4 years, potentially get a little bit more. But I think that they're going to say that opportunity cost of not doing another deal is probably greater than hanging on.
Yeah, locking up your equity when you can buy in a down market doesn't make a whole lot of sense to me. And it's not like it's free because lending costs are not where they were a year ago, right?
Oh, no.
So lending costs have gone up. If you want to, so you say, okay, you know what? I think rates are going to go back to 2% or 1% or 0%, but it'll take 2 years or 3 years. I'm just going to get a bridge loan. Well, those bridge loans are no longer at 5, 6%. You got to pay 10% and such for those, if that. And those lenders these days are a lot more cautious because it's the short term that's a problem, and they're taking a big risk there, so they're going to have a very low leverage anyway. So a lot of people say, well, maybe I'll bring in more equity. Well, that's not cheap. Bringing new equity in a down market is not, it's not free.
It's not a good story. It's a tough story. New equity is like, what am I doing here? And then it's not easy.
It's not like your money's sitting in the bank doing nothing. You've got to invest it in other places. You're taking it from there, and now you're going to be putting it here. And that's a cost you have to realize. That's a cost you have to consider. So I do think that we're still going to have the same amount of loan payoffs due to a sale as we normally used to, except it's going to happen a little later in the year. I think most of that activities have been pushed back maybe a quarter, and you'll start seeing activities ramp up rapidly in the second half of this year. At least that's what I think. But what do I know?
Yeah, well, crystal balls, right? But
but my crystal ball sucks.
Well, we just got to keep pivoting and making the best decisions we can. I certainly think that your platform has a really unique take on the market. I think it's awesome that you've kind of had a proven out business model that just wasn't ready for prime time because the technology wasn't there, and now it is. And I really wish you the best with it. I certainly will encourage folks in my circle to check it out, and we'll have to circle back to make sure that you're doing well, a year from now. And again, we appreciate your time. If people, are interested in learning more, whether it be on the banking side or if they're looking to list properties, how can they reach out and get more information?
Well, obviously they can reach us at info@nxtcre.com, or they can just go on our site, nxtcre.com. Or if they want to reach me directly, and I'm very approachable, so please don't be afraid. My email address is adam@randolphequities.com. Feel free to reach out to me. You can reach out to me on LinkedIn as well. So Yeah, we believe in transparency. We believe in being accessible, and that's our entire model. Our goal eventually is to create greater liquidity in commercial real estate marketplace. That happens when you can provide speed and accuracy, and which is exactly what we do.
Good luck, and I appreciate you coming on. I guess we'll leave it there.